O'Hara, and I'm a partner at Littman Krooks. Our firm focuses in the areas of trust and estates, elder law, and special needs planning, and special education advocacy. Just a couple of housekeeping items. You have a presentation on the right-hand side of your computer screen. If you hit the arrow button, it will open up the chat screen. And then at the bottom, there should be an area where you could enter questions. And if I have time at the end, I will be happy to answer them. I will not be looking at questions during the presentation. If there are any problems with audio or technical, certainly let it says on there where to contact or where to say that in the chat, and somebody is keeping an eye on that. So thank you for joining me. Now, bear with me because now I'm trying to move my screen. There we go. So what do the new tax laws mean, and how does it affect me? The Tax Cuts and Jobs Act of 2017 was signed into law on December 22nd in 2017, with most of the provisions going into effect as of January 1st of this year. The legislation marks some of the most significant changes to our tax law in about 30 years. Now, the senators and representatives in Congress are not necessarily tax experts, but they put the law together, and now it's within the Treasury and the Internal Revenue Service to put together rules, and these rules are usually in the form of regulations. So we will be getting further guidance in the coming months, hopefully, about changes in the jobs in the Tax Cuts and Jobs Act. Today, I'm going to focus on some of the highlights within the Act, focus on income taxes and deductions, estate taxes, and gift taxes. So there were a lot of changes, but I'm really going to only highlight some of them today for purposes of today's webinar. So the income taxes, they have lowered the tax rates and the tax brackets. The top rate now is down to 37%. It was up about 39.6%. So the rates have been adjusted lower. The alternative minimum tax, the AMT, remains in effect, but it is going to impact very few taxpayers because of certain allowances and deductions and higher earning thresholds, which I'm really not going to go into today. But the AMT is still there, but it's going to impact less of us now. One of the major aspects of the Act is that personal exemptions have been eliminated. And personal exemptions in 2017 was we all received a $4,050 exemption, unless if we were higher earning wage earners, and it was phased out for our purposes, for some people's purposes, but this personal exemption existed. It is no longer. There is no longer a personal exemption, with the exception of some qualified disability trusts, which are third-party supplemental needs trusts, which is not the purpose of today's discussion. But if there is a special needs trust that you have for a loved one, and it's a third-party trust, and it qualifies as a qualified disability trust, the personal exemption will remain. And for 2018, that personal exemption is $4,150. Now, they eliminated certain deductions, but they did and exemptions, but they did increase the standard deduction. The standard deduction is now doubled, so it's $12,000 for single taxpayers and $24,000 for married couples who file jointly. The state and local tax deductions, which I'm sure many of us on the webinar today are already familiar with, because New York is a high tax state, and now that our state and local tax deductions are going to be capped at $10,000. That includes school taxes, property taxes, and it's regardless of whether you file single as a single individual or you're married filing jointly. You don't get a double. If you're married, you don't get to make it $20,000. It's $10,000 for all taxpayers, whether single or married in New York State. Mortgage interest deductions, there's going to be a limitation on the deduction to interest paid on the first $750,000 of mortgage interest, unless if the mortgage was obtained before December 16th of last year, which then the cap is at $1 million. So if the mortgage is under $750,000 and there's interest, you are able to deduct that. And this is in these deductions that I'm talking about, and I'll talk about them a bit more when we get to medical expenses, but this is assuming that your deductions exceed the standard deduction of $12,000 for single individuals and $24,000 for married individuals. You have to be able to itemize your deductions on your tax return in order to claim them. Also, what was retained in the law was the exclusion on the sale of your primary residence. That if you sell your residence and it's been your primary residence 2 out of the last 5 years, you could exempt $250,000 off of the gain, and if you're married, you could exempt $500,000 off of the gain. So a medical expense deduction, which we encounter a lot with planning for families here at Littman Krooks, is you can deduct, and this was something that was at stake in the various tax bills, and it resulted in a benefit for many of us who are able to claim this, that for tax years 2017, which is already passed, but we're doing that, we're preparing and filing tax returns now for tax year 2017, and for 2018, you can deduct medical expenses which exceed 7.5% of your adjusted gross income. And what that means is that if your adjusted gross income, or your AGI, is, let's say it's $100,000, you could deduct, and so 7.5% of that is $7,500. If you have medical expenses that exceed $7,500, you may be able to deduct them. And I'll say may because you need to, and I'm going to jump ahead for a minute, because bullet point 2 here is you must be able to itemize the deductions on your income tax return. Because remember, I said before that if you take a standard deduction, $12,000 for single individuals and $24,000 for married individuals, you're not going to, if you don't have sufficient deductions, then you're not going to be able to take this medical expense deduction. But if you do, and your medical expenses exceed 7.5% of your AGI, then you can take this as a deduction. In 2019, it's going to increase to 10% for everyone, regardless of whether you're under 65 or over 65. We had some allowances in the law previously up until for individuals over 65, where we had a 7.5% medical deduction. That's going to change, and come 2019, unless if there's further changes in the law, it's going to be a 10%, meaning in my example before, if your adjusted gross income is $100,000, 10% is $10,000, you could only deduct medical expenses which exceed $10,000. Also, it only covers expenses paid in the year that you actually paid in the year, not when they're incurred. So if you incurred a medical expense in 2017, but you didn't pay the bill until 2018, and assuming that you're able to deduct it, you won't deduct it until on your 2018 tax returns, which would be filed next year. Same thing if you put it on a credit card. It's when your credit card is when it's charged, and that's the year that you could actually take the medical deduction. Also, if the medical expense is covered by insurance, then it's not deductible. If you have any dependents or spouses and that you can claim, remember that you're factoring in their medical expenses as well. Some families have children with critical care needs and have significant medical expenses, and this continues for dependents, whether the child is under or over 18. It's just whether you could claim them as a dependent. I had mentioned this before about you must be able to itemize your deductions. 529 plans, which are the college savings account plans. You are now could distribute up to $10,000 a year if you have children in private schools between grades kindergarten through 12th grade. You're able to distribute about up to $10,000 a year, which can be helpful for many families. Also, and for those that this impacts or are interested in my ABLE accounts, you could we have, I believe, on our website and on YouTube maybe but you could find the link on our website, information on and a webinar that I did previously on ABLE accounts. Now, what you can do is you can roll over up to $15,000 a year from a 529 account to an ABLE account, meaning that if you created a 529 account for your child who is disabled and is not going to be able to use the 529 account to be able to go to college, now you could, before when the ABLE law came out, you weren't able to move money from a 529 account over to an ABLE account. Now you can, but only up to $15,000 a year. And if you contribute $15,000 a year from the 529 account to the ABLE account, you cannot make additional contributions to the ABLE account, because remember, it's capped. For those who are familiar with ABLE accounts, it's capped at what the annual exclusion gift is, which went up to $15,000. This is also is in place until December 31st, 2025. Some of the tax provisions in the Tax Cuts and Jobs Act are set to expire come December 31st, 2025. And this is one of them. So getting into estate planning, and a lot of our estate planning evolves around whether a particular estate may or may not be taxable. And so, you know, I find that when I meet with clients and talk with clients, there seems to be a common misconception between estate taxes and inheritance taxes. So in an inheritance tax, and really, you know, the main difference is that the estate tax is the estate of the person who died is responsible for paying the tax. And the inheritance tax is the individual who's receiving the inheritance is responsible for paying the tax. Federal, we do not have, on the federal level, there is no inheritance tax. There is an estate tax. And there are about only four states in the US that have an inheritance tax. And actually, there's a couple states that have both an inheritance tax and an estate tax, and 12 states, including New York, which still have an estate tax. So the federal, the US, there is an estate tax, and under the new act, the new tax law, the estate tax limitation was doubled and subject to inflation. So our estate tax was set at $5 million, which went up to about $5.6 million for this year, and so due to inflation, and now it's doubled. So what this means is that each individual has an estate and gift tax exemption of $11.2 million. Okay, and if you're married, that's $22.4 million for married couples. So that is, you know, it's not going to impact, and many of us do not have estates that exceed this amount. But planning is still important, especially in New York, which I will talk about. First of all, after 2025, it's going to revert back to the old law at $5 million plus inflation. And you know, so we still want to be careful and mindful of assets and as they grow, as well as life insurance, death benefit proceeds of life insurance, which a common misconception is that they're not includable in the estate. And if you own, and it's not set up in a certain type of irrevocable trust, and you own life insurance, and it could be $1 million death benefit policy or a $2 million policy, that's includable in your estate for estate tax purposes, and is subject to these limits as determining whether your estate has to pay an estate tax. And this is why we still want to be mindful for planning, in that, you know, unless if there's further changes in the law, that our estate tax will revert back after in 2026 to $5 million. Also, who knows if there's any changes in the House and the Senate and presidency that, you know, it could even go lower. This is always you know, an amount that you know, it's open that it could actually go back to, you know, $3 or $4 million. We don't know, but it's just something that we need to be mindful of for planning. The federal estate tax remains at a 40% tax rate. So what this means is that if you die and your estate is over $11.2 million and you're a single individual, you are going to pay tax on a 40% tax on anything that's over $11.2 million, which can be and is, you know, a significant tax. New York, our estate tax through December 31st, 2018, through the end of this year, is at $5.25 million. It was set to adjust to the New York, to the federal level, to the federal exemption for adjusted for inflation, but that's based now upon the old federal law. So I imagine we'll be getting some guidance from New York State as to what the estate tax will be after, you know, come January 1st, 2019, if it's going to set at this rate, or how they will adjust it for inflation. New York does not have a gift tax, which can offer some good planning opportunities these coming years, while we have a higher federal estate and gift tax, because it's a combined estate and gift tax rate, because New York does not have a gift tax. In New York, if you're if you have a filing requirement and your estate exceeds $5.25 million, the estate tax tops at a 16% rate. Now, New York taxes estates differently than the federal government does, in that the 40% on the federal level, you only pay 40% on any assets over $11.2 million. But in New York, once your estate reaches the exclusion amount, you actually pay a tax on the entire amount from $1. You don't pay 16% of anything over $5.25 million, but you actually pay from $1. And it's a graduated tax rate, with 16% being the top tax rate. Under the rules, the basis step up remains. And what that means is that if you buy, let's say you bought a house in 1970 for $50,000, and when you die, it's valued at $1 million. The asset is actually, and let's take away any type of capital improvements on the house, but the house is actually stepped up in value to the $1 million value upon your death, which will eliminate any capital gains. And that's very helpful for families for appreciated assets such as stocks and real estate, to have this step up in basis. The gift taxes. So our annual exclusion, and this actually was not a change, this was already under our existing law. This was not a change under the Tax Cuts and Jobs Act. But our annual federal gift tax exclusion has increased now to $15,000. And that's per donor, per donee, per year, meaning that I can give as many individuals as I want $15,000 every year. And I don't have to report that to the IRS in the form of a gift tax return. If I give amount greater than $15,000, a gift tax return must be filed. However, there's not going to be any actual tax due unless if I have given over $11.2 million during my lifetime. Also, if you're married, you could split gifts, so it's $15,000 per person, so it's $30,000 for the couple. Be mindful of giving gifts, because if you give appreciated gifts, so that if I wanted to give my son stock, Apple stock that I purchased at $10 a share, and now it's valued at $300 a share, and I gave him, you know, several share, a few hundred shares worth of stock, he's going to take my basis of what I purchased that Apple stock at $10. So when he goes to sell it, he could have a significant capital gain. So be very mindful of giving away appreciated assets. And sometimes there's different planning strategies to employ if you wanted to give away appreciated assets. And same thing, and actually, coming just back for the appreciation assets, I experience this regularly with families who want to give their house to their children because maybe they want to employ some Medicaid strategies or other strategies or asset protection that they just want to, say, well, let me just do a deed and I'll transfer the house to my child. Well, then your child is inheriting whatever your basis is that you purchased the house for. Especially if it's not their primary residence where they can't take advantage of the personal residence exclusion, when they sell it, they could be hit with a very significant capital gains tax. What is unchanged are you still have the ability to make unlimited gifts for medical and education expenses on someone's behalf. You have to pay, it's required that you pay the medical care providers and the educational institutions directly, but it's unlimited. It's not subject to the $15,000 annual exclusion limit. So what planning opportunities are here? I think it's important that you review your estate plan, especially if it's been a few years since you've looked at it last. Sometimes there may be some gifting strategies that we could take advantage of over the coming years because New York State does not have a gift tax. And we're in this, period of time where we have a very, very large exemptions of $11.2 million on the federal level and 22.4 million, for single and 22.4 million for married individuals. However, just be very, and this is, the elder law attorney in me, be very careful if we need to consider Medicaid planning or asset protection, that if we're dealing with an older individual that may need some long-term care or has long-term care needs, you just need to very, very carefully consider this and consult, with us, your elder law attorney. And, you always, and I really just mentioned this, but you want to really review and update as necessary any estate planning documents over, every 5 to 10 years. You want to take a look at it. Who do you have listed as your executor and your trustee? Is this person still capable of acting in that role? How about your healthcare proxy and your power of attorney? Are they still capable, or are they aging like you are? I always like to think generationally that if you designate your sibling as your spouse and then your sibling as your fiduciaries, and they're aging with you, well, who's here to help you that's a younger generation that can be trusted and will act in a fiduciary, responsible manner? Anyone in your family has been diagnosed with a disability, any grandchildren, other relatives, your spouse, any type of potential long-term impairments. It's important for us to review and make sure that your estate plan still works for everyone's benefit and protection. I always think it's important for everyone, including myself, to review your beneficiary designations every couple years. Even, when you review, minimum every 5 years, look at your estate plan, look at your beneficiary designations to make sure that they're correct and as they should be. Beneficiary designations are you always have them on your retirement accounts and life insurance. And sometimes they're on brokerage accounts, and sometimes they contradict with the estate plan that's in place, that maybe we don't want to list somebody individually on a brokerage account or a bank account, that maybe we want to have another planning plan in place. Also be mindful of listing any minors or individuals with disabilities outright on beneficiary designations. I'm involved in a situation currently right now in court where grandma left her minor grandchild as a beneficiary of an IRA account, and now the parents are needing to become the guardian at the court to be able to administer the IRA, which has required distributions, and what the court guidelines and rules aren't necessarily make the most sense with regard to the RMDs and what the parents want, and it's very frustrating for the family. So it's important to look at these. And I'm going to see, I don't have my question page, so let me see if there's any questions. So the step up, does the step up remain for federal, for federal estate assets? Yeah, so the step up is in basis, applies to all assets in which an individual owns at death. So if whatever you own, it's both from a New York level and a federal level, that the asset, the value of the asset is stepped up to the date of death value when the person dies, to virtually eliminate any capital gains tax. Please clarify, it can be different. Bear with me while I read this. Okay, so when I mentioned before on the medical expense, hold on, let me just go back to that slide. So the medical expense deduction, there was a good question asked that you take the deduction when the credit card is charged or when the actual bill is paid. So if you charged your credit card on December 15th for 2018 or any year, December 15th, and you charged it for a medical expense, but you actually don't pay the credit card bill until 2019, when do you take it as a deduction? It will be for the tax year 2018. Okay, back to the step up in basis question. Do the assets need to be in the trust to get the step up in basis? That is a very, that's actually beyond today's, because the answer is it depends. It depends how the trust is set up. And some trusts, whether, if it's a revocable trust, then it's not stepped up. It's not stepped up. Because the revocable trust uses the person who the settlor, the person who creates the trust, social security number, and also is the person who still owns the asset, even though it's in trust. So the asset is not stepped up. If it's in an irrevocable trust, it depends on how the trust is set up, whether it's a completed gift or not, and how in what the tax treatment is. So I'm sorry, I can't answer specifically because it depends on the trust and if the trust was already set up, or if we're actually actively setting up the trust, and an appreciated asset is transferred to an irrevocable trust. Careful consideration needs to be had to review, okay, whether there would be a recognition of gain at that point. Okay, if somebody has a child with a disability, and you deed half the house to the child, so there's different, child with a disability that may be receiving Medicaid benefits, and you receive, for your own purposes, you want to protect the asset for the benefit of your child, because of your long-term care possibly, and your child's medical needs that he or she is on Medicaid. There is an exemption under the law that you can transfer your home to a child with a disability who has been recognized disabled, and that's an exempt transfer for you. However, you do need to consider the capital gains consequences there, as well as the impact it will have on your child for their benefits. Because if it's their primary residence, the house may be exempt if the value of the house is under $840,000. However, that does not stop Medicaid from putting a lien against the home and putting a lien against the home for any Medicaid paid on behalf of the child during his or her lifetime. So again, that's a question that you need very careful planning and oversight on and counseled, and not just sort of run and do it without proper thought through it. How can you use trusts in your estate planning to protect assets? That's actually I could spend a half an hour, and that may be a good subject for another webinar, because that's a very long conversation. But you can use trusts to protect assets for long-term care. But careful consideration needs to go in terms of the health of the individual, how much time we have, what assets are remaining outside of the trust, and how much time I have, meaning like, are we going to be subject to a 5-year look back for long-term care Medicaid planning? So there's a lot of considerations that need to be had there. But that, Maria and Kian, if you could jot that down, because that would make a good topic for a future webinar. Okay, bear with me, because there's a lot of questions coming in here. So any considerations, any changes for the generation skipping transfer consequences? It's the same. I didn't get into GST planning today, but the exemption also increased. So the estate and gift tax and GST exemption increased to $11.2 million starting 2018, and for married individuals is $22.4 million. Okay, so is Congress still interpreting the allowability of prepaid property taxes as a deduction for 2017? I don't know how Congress is going to treat that. There was a lot of discussion on that issue at the end of December. And I do know that there was a requirement for the properties to be assessed, already have some type of assessment in place. And I even think it may be something that New York State, if they have not already, maybe commencing some litigation. I don't know. I've heard different things, and that was just really more in the media. So I don't know exactly how that's going to be interpreted. And it could very well be that we're waiting for the IRS and Treasury Department to issue regulations on guidance. Bear with me, I'm just reading. Sorry for the silence. I'm looking through some more questions. The person who, and I'm not going to say the name, but the person who does not live in New York State but has a child that lives in New York State and wants to discuss long-term care planning, I recommend that I think that you have to both consult with an elder law attorney, both in the state in which you reside, as well as we could help out with regard to the New York issues. But there are likely different planning opportunities, but it's going to involve working, at least with consultation with a lawyer in your state as well as New York for your son's purposes, and your state for your purposes, for your planning. Okay, I think I've covered almost all the questions. Does anybody else have any other questions before I end this? Well, I really appreciate everybody joining us today. If I went through items too quickly, or you have further questions, just send the first of all, we will be posting this on our website, so you could review this webinar again on our website. Just give us a few days. It will probably take a few days to get it together, and you'll be able to see the PowerPoint on the website through however they upload it, and then certainly you could email the organizer any questions. Thank you so much for joining us today. Bye-bye.